Hi, this is Scott from Scalpel Senior Trader, and this is using ATR, average true range, for entries and stops. So for those of you that don't know what average true range is, it is just a gauge of current volatility in the marketplace. I use the standard thicker swim ATR, which is a 14 period Wilders ATR. This is just the default settings for that, and it's perfectly fine. You can go to this link here to read more about it. I'm not going to get into the formula for the ATR and so on and so forth. I just use it as a gauge of volatility. I've determined, over the years that 5-minute ATR is the best suited for the day trader type of trade, where 1 minute, 2 minute, that's too short of a time period, and 30 minutes, 60 minute, that is too big of an ATR to be trading for the day trading and for the setups that we're using. So I have determined the 5 minute, or I use the 5 minute. And again, if you want to read more about it, here's your link, and you can read all about it. So the ATR is showing you here in this instance. This is after, this is crude. This is after the market close. It's not as elevated as it usually is, but this is showing you all you're doing is basically taking, this is showing you two decimal places past. There's the two numbers after the decimal place, which is the same as up here, right? So it's just showing you what these two numbers are. So this is representing 15 ticks, right? So that's what the current ATR is. Again, this is showing you right at this time of day, which is after hours. But 15 ticks right now would be the ATR, where you would use this to gauge based on your zones, your entries and stops, which we'll go over here. This is an example of the E-mini S&P ATR. At this specific instance here, it was, you can see 8.02. This is just showing you in graphical form, and then this is just the cursor showing you right here at this time of day. So this is telling you right now it is an 8 ATR. I like to round up. If it goes, anything over 8, I will round up. ES does not trade in tenths of a tick, so I like crude does. So I will round, it trades in quarter ticks, so I will round this up to 8.25 as my current ATR to judge my entries and exits, which we'll get into. There is a certain time when you will not be, or I do not use the 5-minute ATR. I will revert to the hourly ATR, and that is when you get a one-time event, like in this example, it's a natural gas storage report number, which comes out every Thursday at 9:30 Central, or a crude number, or the Fed releasing their interest rate hike, things like that, where it is just basically a one-time event. You can see here this ATR spiked from right around 40 to 72.5 or 73 ticks in this instance, where that is not representative, in my view, of the current volatility. It is taking into consideration this one-time event, and you can see as it started to normalize back to the 40 area once that event happened. So the best way to do this, and again, this is maybe 2% of the time that I will use a percentage of the hourly ATR. In this case, you want to use 20% of an hourly ATR. So this is that same spike. You can see here the hourly ATR at that time was 178.3, so you can say 179 ticks, right? So in this instance, I would take 20% of the 179, or 178.3, I should say, initially, which will give me a 35.66 ATR, right? So I would round that up to 36 ticks, and you can see that 36 ticks is it's indicative of what the real volatility is, what it was before the spike, and then what it came back down to. So, once the number comes out, you can take 20% of an ATR and only be risking 36 ticks outside of your zones for your stops and entries versus 73. It's just not necessary to be risking that much, from my experience. And then this is an example on how you would use this with your SI indicator setups, which you have learned in the other videos on how to draw these zones. So once you determine, you see here, this was almost 2,000 sell ice, 1,900 sell ice, back-to-back spikes there. I drew this zone incorporating that, and the top of the zone here is 37.65. The bottom is 37.65 3/4. The bottom of the zone is 37.54 1/2. I had to draw these in here manually because I covered the prices with this chart. So you do not know what this setup is. I've determined this after thousands and thousands of setups until it can get an ATR away from these zones. You have these algorithms that will revert. They pick up these volume events just like you can see them, and they will revert the market back to the volume event many, many, many times at an ATR. So there's two things you need to understand here. One, I want to see a full ATR to determine what type of setup this is, right? Because I don't know whether this is a broken ice setup or a Titanic setup. A Titanic setup would be, from other videos, as you know, that sell ice comes in, stops the market, and continues to go in the way of the setup, or way of the ice. The other setup, which this one is the broken ice setup, right? Where the sell icebergs came in and they couldn't hold the market. This market was able to get a full ATR above this zone. The minute it gets a full ATR above this zone, I know this is a broken ice setup, right? And then my entry is going to be just outside of an ATR. I've determined, again, by trial and error, a lot of error, where if you can put your entry just outside the ATR, it's better than doing it just inside. I've tried to save a few ticks for a long time, getting in before the full ATR or outside the ATR, and it's cost me a lot of money where I would get filled to the tick and then these algos would run it back. So I will wait for just outside an ATR. Usually two, 3 ticks is fine. And you have to use a little bit of judgment here. On more volatile days, you can make it a point, a little over a point. But I've determined a couple ticks is sufficient, right? So for in this instance, the ATR was 8.44, as you can see there. You round up to 8.5. So my entries and my stops would be just outside that ATR, which would be in this case 2 ticks or 9 points, right? So I've determined out of here that this is an ATR, or this is a broken ice setup because I got the ATR out of here. Now there's 1 or 2 ways you can enter this trade. It's aggressively, which we'll talk about in other videos as well. It's either the aggressive entry or the retest failure entry, right? So either way, it's still going to be outside of the ATR, the 9 points. So if the top of the zone is 65.75, I will be getting in at 74.75. That's the 9 points, right? So I can either enter this trade aggressively when it hits 74.75, and it looks like it hit that to the tick, and this is what happens, right? A lot of times, this was actually outside the ATR, and it still happened, but the point is you can get in aggressively, and that's what you have to determine as well. There's times, I have specific instances where I enter aggressively. I'm not going to get into that in these videos, but there's times I'll get in aggressively, and there's times I will wait for the retest failure to get in, and that's the more conservative entry. Obviously, if you're waiting for retest failure, it doesn't always retest the zone, so you have to determine, are you okay with waiting? I would say, from my experience, the market will retest the zone probably 75% or more of the time. It will come back and retest it, but there's times that this will just keep going, and if you are waiting for a retest failure, you are going to miss the trade. You just have to be able to live with that. Certain markets retest more often than others. Crude, gold, soybeans, natural gas, they tend to retest, I'd say, over 80% of the time. Other markets will continue, run, like NASDAQ will a lot of times just keep running. So again, based on what you're looking at, you have to determine, am I getting in aggressively, or am I waiting for ATR retest failure? So that's my entry, and then my stop will go outside of an ATR below the zone. So in this instance, if I were to enter my trade 9 points above the top of the zone, I'd be in long, and then based on the broken ice setup, I would be in long here, and then my stop will go 9 points outside of the zone, the bottom of the zone, which is 54.50, so my stop will go 37.45.50 again. And this is where you want to be, there's so many traders that will put on trades, they'll follow these rules, and they'll say, well, I only want to risk 4 points on this trade. You want to make the market prove that it can get through the volume event and a full ATR outside of there for your safest type of trade. If you're putting in your stop 4 points away from your entry, you're just opening yourself up for algo whipsaw, which is 90% of the trade, right? When you put your stop outside of an ATR, outside of the zone, you're making this market prove it can get through this volume event and push through a full ATR where you have algos trying to snap it back, right? So this is the best place for your stop. I know a lot of traders want to just risk a couple points, and it's just an exercise in futility. So it's not worth it to be whipsawed the safest entry and exits are waiting for outside an ATR and exiting outside of an ATR. So that is the best method to trade these. Again, if you want to risk placing stops anywhere here, you're opening yourself up to algo city probably most of the time. So that is how I use ATR for my entries and my exits based on the volume event.